You enter a trade and the price drops against you. The immediate psychological temptation is to buy more, to artificially lower your average entry price. You assume a quick bounce will bring the trade back to break even, rescuing a fraying position. This instinct originates from a proven investing concept. By dropping a fixed amount of money into an asset on a strict schedule, known as dollar cost averaging, you smooth out market volatility. Regular purchases keep your average cost below price peaks. That strategy works in equity markets because you are buying shares in companies that innovate, grow earnings, and hold intrinsic value. The broader market carries a historical upward bias, and these purchases are made with unleveraged cash. Intermediate traders often attempt to port this exact behavior over to the currency markets, reactively adding to a losing position and calling it averaging down. Forcing a patient, unleveraged strategy onto the volatile, leveraged currency market creates a direct path to account liquidation. The first problem is the asset itself. Unlike a company stock, currency pairs like the euro and the US dollar possess no intrinsic value. There are no quarterly earnings reports or physical assets to trigger an inevitable recovery. Currencies trade on the relative macroeconomic strength between two nations. Because of this, a pair can trend in one direction for months without ever becoming undervalued. The second factor is leverage, controlling a massive position with just a fraction of the capital. Leverage amplifies potential profits, but it also accelerates losses with the same weight. This diagram shows the mechanics of a margin squeeze. Every time you buy into a losing trade, it adds to the position size on the left, which increases the margin required to keep your trades open. Simultaneously, the mounting floating loss on the right drains your available free margin. In traditional investing, a market dip is a sale. In Forex, averaging down into a dip accelerates you toward a forced broker margin call. This chart plots the anatomy of a standard trade turning lethal. A trader buys one mini-lot of euro-dollar at 1.0800. They establish a strict, predefined risk of 50 pips, accepting a $50 lawsuit to trade fails. The price drops 50 pips to 1.0750. Driven by the sunk cost fallacy, the trader refuses to accept the initial failure. They buy a second mini-lot to drag their average entry price down, and the risk zone expands. The price drops again to 1.0700. Convinced a reversal is due, the trader buys two more mini-lots. They now hold 4 lots deeply underwater, and this massive position is consuming every drop of remaining margin. A final 50-pip drop pushes the price to 1.0650. The initial $50 risk has multiplied into a $350 loss. Averaging down converts a routine, manageable technical failure into a catastrophic blowout. Scaling into an open position is a core component of professional trading, but only when moving in the correct direction. This diagram illustrates the alternative, pyramiding. Instead of funding losers, you proactively scale into profitable positions. You add successively smaller sizes after technical levels break. As the market proves you correct, a protective stop-loss ratchets up beneath the ascending blocks. By moving the stop-loss up with each new addition, you lock in accumulated profits and shield the entire position from sudden reversals. Pyramiding presses a mathematical advantage based on market proof. Averaging down doubles a mistake based entirely on hope. Professional scaling is impossible to execute without first mastering the non-negotiable foundations of risk management. This requires two ultimate safeguards: a hard stop-loss on every single trade, and position sizing that risks no more than 1 to 2% of your total account capital. Treating your trading plan like a rigid business plan removes ego from the equation. It neutralizes reactive emotion and the urge to average down. To build out your rules, utilize FXNX's advanced charting tools to backtest your risk management models and refine your precise entry and exit criteria. Capital is your most valuable asset. Protect it by discarding the myth of averaging down, trusting your technical levels, and